and welcome to Money Wealth Finance, where we provide insights and tools to help you navigate the world of finance and build a secure future. Today's discussion is brought to you by Fennel Wealth Management, a trusted partner in achieving financial goals and preserving wealth. Stay tuned to learn how they can support you with their contact details shared at the end of this session. Today, we're diving into one of the most critical topics in investing, diversifying your portfolio. It's a strategy you've likely heard about, but what does it really mean? And why is it so important? By the end of this discussion, you'll not only understand the concept, but also have actionable steps to diversify effectively and confidently. What is diversification? Diversification is the practice of spreading your investments across various assets, industries, and regions to reduce risk. Think of it as a safety net for your portfolio. Instead of putting all your eggs in one basket, you spread them across multiple baskets to protect yourself from losses if one basket fails. For example, if you invest only in one company, your portfolio's success is tied to that company's performance. If the company faces challenges, your entire portfolio could suffer. But if you spread your investments across different companies, industries, and asset classes, a downturn in one area is less likely to significantly impact your overall returns. Diversification doesn't eliminate risk entirely. Instead, it helps manage it, ensuring that no single investment can dramatically affect your financial stability. Why diversification matters? Diversification is vital because it addresses one of the fundamental truths of investing. Markets are unpredictable. No matter how much research you do, no one can consistently predict which asset classes or industries will perform best in a given year. Diversification allows you to hedge against this uncertainty by spreading your investments across multiple areas. Let's take an example. In 2008, during the global financial crisis, the stock market plummeted, but certain bonds and commodities like gold performed well. Investors with diversified portfolios were able to offset some of their stock market losses with gains in other areas. This balance is the cornerstone of diversification. The benefits of diversification. Let's explore the primary benefits of diversification. First, diversification helps manage risk. By spreading your investments, you reduce the impact of a poor-performing asset on your overall portfolio. Second, it provides more consistent returns. Different asset classes react differently to market conditions. For example, stocks might perform well in a booming economy, while bonds may provide stability during a downturn. A diversified portfolio smooths out these fluctuations. Third, diversification offers access to broader opportunities. By including investments from various sectors, asset classes, and regions, you can tap into growth potential that you might miss if your portfolio is too concentrated. Finally, diversification helps protect against emotional investing. When markets are volatile, it's easy to make impulsive decisions. A diversified portfolio can give you confidence to stay the course, knowing that your risk is spread out. Now that we understand the benefits, let's discuss the different ways to diversify your portfolio. This involves spreading your investments across different types of assets, such as stocks, bonds, real estate, and commodities. Each asset class has unique characteristics. Stocks typically offer higher growth potential but come with greater volatility. Bonds, on the other hand, provide more stability and predictable income. Even within a single asset class, such as stocks, it's important to invest across multiple industries or sectors. For instance, instead of concentrating only on technology stocks, you could also invest in healthcare, energy, or consumer goods. This protects you from sector-specific risks like regulatory changes or shifts in consumer behavior. Geographic diversification involves investing in assets across different countries or regions. While domestic investments are important, international markets can offer growth opportunities and help hedge against risks tied to a single economy. For example, an investor with exposure to emerging markets might benefit from faster growth rates in those regions. Another layer of diversification is based on company size, large cap, mid cap, and small cap stocks. Large-cap companies tend to be more stable and established, while small-cap companies offer higher growth potential but carry more risk. Time diversification, also known as dollar cost averaging, involves investing consistently over time, regardless of market conditions. By spreading your investments across different time periods, you reduce the risk of investing a large sum just before a market downturn. This strategy smooths out the effects of market volatility and helps ensure you're buying more shares when prices are low and fewer when prices are high. To truly understand the power of diversification, let's dive deeper into how it minimizes risk. The key concept here is correlation. Correlation measures how two investments move in relation to each other. Investments with high correlation tend to move in the same direction, while those with low or negative correlation move independently or even in opposite directions. For example, stocks and bonds often have low or negative correlation. When stock prices decline during a market downturn, bonds may hold their value or even increase. Including assets with low correlation in your portfolio reduces the overall volatility and creates a smoother investment journey. Here's a practical example. Imagine an investor who puts all their money into the technology sector. If a tech bubble bursts, their entire portfolio could lose value. Now imagine another investor who allocates their funds across technology, healthcare, consumer goods, and energy. While the tech sector might experience a downturn, gains in other sectors could offset those losses, resulting in a more balanced portfolio. Building a diversified portfolio doesn't have to be complicated. It starts with understanding your financial goals, risk tolerance, and time horizon. Risk tolerance refers to how much risk you're comfortable taking. Younger investors with longer time horizons might lean toward more aggressive portfolios with a higher allocation to stocks. Those nearing retirement, however, might prefer a more conservative approach with a greater focus on bonds and other stable investments. Asset allocation is the process of dividing your portfolio among different asset classes based on your risk tolerance and goals. For example, a moderate investor might allocate 60% to stocks, 30% to bonds, and 10% to real estate or commodities. This mix should reflect your individual circumstances and financial objectives. Once you've determined your asset allocation, it's time to choose specific investments. For stocks, consider a mix of large cap, mid cap, and small cap companies across various industries and regions. For bonds, include a mix of government, corporate, and municipal bonds with different maturities. Real estate investments might include direct property ownership, REITs, real estate investment trusts, or crowdfunding platforms. Index funds and exchange-traded funds, ETFs, are excellent tools for diversification, especially for smaller portfolios. These funds pool money from many investors to buy a broad range of assets, providing instant diversification at a low cost. For example, an S&P 500 index fund gives you exposure to 500 of the largest companies in the US, while an international ETF might include companies from dozens of countries. Over time, market movements can cause your portfolio's asset allocation to drift from its target. Rebalancing involves adjusting your portfolio to bring it back in line with your desired allocation. For instance, if rising stock prices increase your equity allocation from 60% to 70%, you might sell some stocks and reinvest in bonds or other assets to restore balance. While diversification is essential, it's possible to overdo it. Over-diversification occurs when you spread your investments so thinly that your portfolio becomes overly complex and diluted, reducing potential returns. For example, holding 100 different stocks might spread risk, but it can also make it difficult to achieve meaningful growth. A portfolio with 20 to 30 well-selected investments across asset classes and sectors can often achieve better results than an overly complex portfolio. The key is finding a balance. Diversify enough to manage risk, but not so much that your portfolio becomes unwieldy or diluted. Diversification has been a cornerstone strategy for many successful investors. Let's look at a real-world example to highlight its importance. Consider an investor during the dot-com bubble of the late 1990s. Many individuals had portfolios heavily concentrated in technology stocks, chasing high returns as tech companies soared. When the bubble burst in early 2000, these concentrated portfolios lost a significant portion of their value. Now compare this with another investor who diversified across technology, healthcare, consumer goods, and international markets. While the tech sector collapsed, other sectors in their portfolio performed relatively well, cushioning the impact of the market downturn. Over time, this diversified portfolio recovered faster and generated more consistent returns. This isn't just an isolated case. Historical data consistently shows that diversified portfolios tend to outperform concentrated ones in the long run, particularly during periods of market volatility. Despite its proven benefits, there are several myths about diversification that can lead investors astray. Let's address a few of the most common ones. Myth 1. Diversification guarantees profits. Diversification reduces risk, but it doesn't eliminate it entirely. All investments carry some level of risk, and market downturns can still affect a diversified portfolio. However, diversification helps you manage and mitigate those risks over time. Myth 2. The more investments, the better. While having multiple investments is a key component of diversification, simply owning a large number of assets doesn't guarantee a well-diversified portfolio. For example, if all your investments are in the same industry or asset class, you're still exposed to significant risk. True diversification requires thoughtful allocation across different asset classes, sectors, and regions. Myth 3. Diversification is only for wealthy investors. Some people believe you need a large portfolio to diversify effectively, but this isn't true. Low-cost index funds and ETFs make it easy for even small investors to achieve diversification. With as little as $500, you can start building a diversified portfolio. Myth 4. Diversification is a one-time process. Diversification isn't a set-it-and-forget-it strategy. Over time, your portfolio's allocation may drift due to market movements. Regular reviews and rebalancing are necessary to maintain the appropriate level of diversification based on your goals and risk tolerance. While diversification is a powerful strategy, it's important to avoid these common pitfalls. True diversification requires including investments with low or negative correlation. For instance, if you hold multiple tech stocks, your portfolio isn't truly diversified, as those stocks are likely to react similarly to market events. Some investors focus solely on high-yield investments like speculative stocks or risky bonds. While these may offer higher returns, they also come with increased volatility and risk. A balanced approach is essential. Many investors focus only on domestic markets, missing out on opportunities in international and emerging markets. Geographic diversification is crucial for reducing risk tied to a single economy or region. While diversification involves spreading your investments, excessive buying and selling can lead to high transaction fees. Use low-cost options like ETFs and index funds to diversify efficiently. Diversification is not just about protecting against losses, it's about positioning your portfolio for consistent growth over time. Here's why it's essential for long-term success. First, diversification helps you stay invested. Market volatility can tempt investors to sell during downturns, locking in losses. A diversified portfolio provides stability and confidence, making it easier to stay committed to your investment plan. Second, it supports steady compounding. By smoothing out volatility and reducing the impact of large losses, diversification allows your investments to grow steadily over time. This steady growth is critical for compounding, which is the key driver of wealth accumulation over the long term. Markets are cyclical, and different asset classes perform differently depending on the economic environment. Stocks might lead during periods of growth, while bonds or commodities like gold might perform better during downturns or inflationary periods. Diversification ensures that your portfolio is well positioned for any scenario. Building and maintaining a diversified portfolio can be complex, especially for those new to investing. or with limited time to manage their portfolios. This is where professional guidance comes in. A financial advisor can help you assess your risk tolerance and set realistic financial goals. Determine the right asset allocation for your needs. Identify opportunities across different asset classes, sectors, and regions. Regularly review and rebalance your portfolio to ensure it stays aligned with your objectives. Advisors also help you navigate market downturns, avoiding emotional decisions that could derail your long-term strategy. This kind of support is invaluable for building and maintaining a resilient portfolio. It's important to note that while diversification is a universal principle, every investor's strategy should be tailored to their unique circumstances. Factors such as age, income, financial goals, and risk tolerance all play a role in determining the right level and type of diversification. For example, a young investor with decades to invest might focus heavily on stocks with a smaller allocation to bonds or alternative investments. Meanwhile, a retiree might prioritize stability and income, allocating more to bonds and dividend-paying stocks, while keeping a smaller exposure to equities for growth. This balance ensures that your portfolio isn't just diversified, it's also aligned with your personal financial journey. A historical perspective on diversification. To understand the long-term value of diversification, let's take a look at historical data. Over the past century, diversified portfolios that included a mix of stocks, bonds, and other asset classes have consistently outperformed concentrated portfolios, particularly during periods of market stress. For example, during the 2008 financial crisis, portfolios that included bonds, gold, and international equities fared significantly better than those focused solely on US stocks. Similarly, during the COVID-19 pandemic, technology and healthcare stocks surged while other sectors struggled. Investors with exposure to these high-performing sectors benefited, while those concentrated in industries like travel and hospitality faced steep losses. These examples highlight why diversification is essential. It helps you capture opportunities in high-performing areas while reducing the impact of underperforming ones. Technology and tools to aid diversification. In today's digital age, technology has made diversification easier and more accessible than ever. Online platforms, robo-advisors, and investment apps offer tools to build and manage diversified portfolios with minimal effort. For example, robo-advisors use algorithms to create portfolios based on your risk tolerance and goals, automatically rebalancing them as needed. These platforms often offer low fees and can be a great starting point for beginner investors. Additionally, financial education resources and portfolio analysis tools are widely available, helping you make informed decisions about your diversification strategy. Now that we've covered the importance, benefits, and methods of diversification, here are a few steps you can take today to start diversifying your portfolio. 1. Review your current portfolio. Take stock of your current investments. Are you heavily concentrated in one asset class, sector, or region? Identifying gaps in your diversification is the first step to improving your strategy. 2. Start small. If you're new to investing, begin with a diversified index fund or ETF. These funds provide instant diversification across hundreds or thousands of assets, making them an excellent option for beginners. 3. Set clear goals. Define your financial objectives and determine how much risk you're willing to take. These factors will guide your diversification strategy. 4. Consider professional advice. If you're unsure where to start, consult a financial advisor. They can help you create a personalized, diversified portfolio tailored to your needs. 5. Stay consistent. Diversification isn't a one-time effort. Commit to regularly reviewing and rebalancing your portfolio to maintain the right mix of investments over time. Diversification is one of the most important strategies for building a resilient and successful investment portfolio. It reduces risk, stabilizes returns, and positions you for long-term growth. By spreading your investments across asset classes, sectors, and regions, you create a financial safety net that allows you to weather market storms and seize new opportunities. Our sponsor, Fenul Wealth Management, specializes in helping individuals and families build well-diversified portfolios tailored to their unique goals and risk tolerance. Their team can guide you through every step of the process, from assessing your risk profile to maintaining and rebalancing your portfolio. To learn more, contact Fenul Wealth Management at 888-336-8586. Visit their website at fenulwealthmanagement.com, or email them at info@fenul.com. If you found this discussion helpful, don't forget to like, share, and subscribe to Money Wealth Finance for more insights into managing your money effectively. Thank you for joining us, and we'll see you next time.